From New York City for viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, traders reduced their January rate cut bets following an unexpected drop in unemployment. The fate of President Trump's tariff agenda remains in limbo as the Supreme Court punts on a ruling. And global bond sales climb to a record to kick off the new year. We begin with the big issue, the next steps for the Federal Reserve.
The most important number there is that unemployment rate.
January cut is off the table.
It's a little early to say this data is enough to reach that conclusion.
Where market watchers go wrong is they spend too much time looking at the headline number and not enough time unpacking what's underneath.
I don't think we can assume after a big jump a couple months ago that a 1 month drop of a tenth and a half is an end to that trend. So I think they're going to be on course for cautious cuts.
There is a lot of concern and angst about the labor market.
We've just been consistently trending higher in the unemployment rate.
We're going to start to see some signs of the labor market stabilizing over the next several months.
We might not see another rate cut through 2026.
The Fed is probably a lot less dovish than people think.
The dual mandate is a little more in balance.
Does the Fed cut in January? Probably not.
We don't think the Fed will cut again under Chair Powell.
The most immediate catalyst for what the Fed does next was today's December jobs report, and it was a mixed print. The headline number, which is non-farm payrolls, that missed estimates, 50,000 versus the expected 70,000. Now, the November number was revised lower as well, so keep that in mind. Meantime, you look at the unemployment rate, which we know Fed Chair Jay Powell is paying more attention to. That fell unexpectedly to 4.4% from the expected 4.5%. Participation rate and average hourly earnings wages, that pretty much came in line with expectations. So just to put the December headline jobs number in perspective, over a 3-month period, we've now seen a drop in payrolls to the tune of 22,000. And you can see all of that is a result of the October print of a loss of 173,000 jobs. Now, BlackRock's Rick Reeder, who is a Fed chair candidate, is using that contraction in payrolls to support his dovish thesis.
If you go back 8 months, the total net jobs is negative 213,000 jobs net of healthcare. What I think is going on is we have a productivity revolution of extraordinary proportion, that we have an economy that's growing at a quite robust rate, but we just don't need the people. I don't think the story is ambiguous. I think the story is quite clear. We have a labor dynamic that is tricky. I've been pretty adamant that I think the funds rate needs to be, I think interest rates need to be a bit lower, because I think it's lower skilled. I think it's low income. I think it's small business that are on the backside of what is a tough dynamic today.
All right, let's dig into all of that with our macro roundtable. Lindsay Rosner is head of multi-sector fixed income investing at Goldman Sachs Asset Management, and Blake Gwinn is head of U.S. rate strategy at RBC Capital Markets. Lindsay, let me start with you. Do we have a macro environment that's ambiguous or clear?
Well, we have a macro environment that's getting clearer. I think that's key. Today was data that I think the market was excited about because it was clean. This is the first data we've had that's clean since the shutdown. What is clear from the data today is that January is unambiguous. The Fed will not be cutting in January.
The Fed will not be cutting in January. In fact, traders keeping their outlook for 2 cuts this year, with the first by mid-year, Blake. How does this set us up in terms of positioning for the upcoming inflation data, given that you call this current environment a low conviction, low volatility environment?
Yeah, I do think it's going to be hard for that inflation data to really change the dynamics around near-term Fed cuts. I think the Fed has been much more focused on what's happening in labor markets, and part of the insurance cuts that we got late last year were entirely based on these kind of labor market fears. So we've really kind of moved away from the inflation side of the mandate right now. So I just don't think that's really going to change the picture in the near term. We actually joined Lindsay today, changed our Fed call. We had one in January. I wrote yesterday that, I think to get that January cut, we would have really needed to see some of that softness we saw in November kind of continuing into this December print. We obviously didn't see that today. We are much more focused on the unemployment rate than the payroll number and some of the other metrics. And we just didn't see that weakness. So I think it's really going to be hard for the Fed to cut at this meeting. And we now have the Fed on hold for the rest of this year.
Lindsay, why is the bond market, for the most part, feels like it's not budging at all? You look at the 10-year yield, and it's been stuck between 4.1 and 4.2% for most of the past month.
Right, because I think it goes back to the ambiguity it has been dealing with, right? We had the government shutdown. We had data that started to slowly leak out, but was stale. And it's hard to really have, kind of back to Brian's point, a ton of conviction on what that means. The second piece of it that's leading to just the range that we're in is you have to remember we're in the current Fed regime, likely for just 3 more Fed meetings. We're going to get a new chair. That's a new regime. That's going to come in the back half of the year, and it'll be a bit of a different world. So in terms of having conviction, until I think we have a better idea of who that Fed chair will be, hear a little more, see more data, it's going to be harder to be convicted to say, I want to be longer duration or shorter.
What are you seeing, Blake, in terms of how investors are positioning themselves for the first part of 2026 until we get clarity on things like the next Fed chair?
Yeah, well, I think that position is actually fairly light. A lot of the people we talk to have been staying very close to kind of their benchmarks. I think people have been very hesitant to take risk. That is both, I think, driven by and a cause of these very tight ranges in this low vol environment. I think the low vol kind of encourages people to kind of pull back and wait. But at the same time, that pulling back and waiting is also making those tight ranges even worse. So I really think we just don't have a lot of conviction in where things are going. I mean, back to Lindsay's point, I think there's been a lot of ambiguity. People are uncertain about what's happening with the Fed chair. There's kind of headlines. I mean, we're only a week, one trading week into the new year. We've already had 3 or 4 major kind of developments coming out, and I think it just kind of freezes investors to some degree. Now, if there is one position that I would say is still kind of prevalent across the markets, people still like curve steepeners. I think they just like those kind of dual risks. You kind of have that insurance, if you will, against a bigger downturn where people would kind of benefit from those rate cuts at the front end. Or you get into some scenario where there's a scare about Fed independence, there's another kind of freak out about deficit levels or supply, and you could see the back end rise as well. So I think people kind of like being in that position because it benefits in both of those ways. But even that positioning is light relative to where it was at points during the last year.
Now, one of the developments that you referred to, we got this week, is President Trump's plan to increase housing affordability, having Fannie Mae and Freddie Mac buy $200 billion of mortgage bonds, which feels like a form of QE by GSEs rather than the Fed aimed at lowering mortgage rates. Lindsay, would more demand for mortgage bonds actually move mortgage rates in a meaningful way?
So the estimates are that it could move the mortgage rate lower, maybe 1/4 percentage point. Does that really bring a tremendous amount of people off the sidelines into buying homes? Incrementally, it will improve it, but we don't think that it will be really extreme. But I do want to circle back on something in terms of maybe it's difficult to have conviction in terms of should yields be lower necessarily from here. I agree with Blake in terms of we do think that a steepener in rates makes sense. But the biggest thing, and back to what this Trump announcement tells you, is we are very convicted on being an active manager. And when you have policies like this that say, for example, the runoff that we're seeing by the Fed could be countered exactly in the same magnitude by the GSEs. This is important for the markets and makes a difference in terms of how you want to position your portfolio. So the conviction around active management is very much here.
So how do you fold in this policy announcement to your 2026 outlook, Lindsay? Does it change how you want to allocate to fixed income at all?
Yeah, so there are opportunities in fixed income. I think that this makes the mortgage space a little bit more interesting. And right now, this specifically talks about conventional mortgages or ones that have to do with the GSEs. We actually think that this is kind of lifting tide, that may make non-agency residential mortgage-backed securities, an area that we've liked before, even more interesting.
What do you think, Blake? How do you fold in what we've heard from the president this week on mortgage bonds?
Yeah, I kind of agree with Lindsay's point. I think the actual impact on mortgage rates themselves is probably low. I would even take perhaps the under on that 25 basis points. So it's not going to be something that's really game-changing for home ownership decisions for people, I don't think. Where it gets interesting, I think, if this is the beginning of something bigger, if they're announcing $200 billion, but they're more going to be more aggressive in kind of lifting those caps going forward, and maybe those purchases could grow in the future. We'll see where that goes. And even in rate space, kind of how the GSEs are actually handling those purchases, how they're hedging them could have some impacts on the rate space as well. So we're certainly watching that, but 200 billion, it sounds like a very large number, but in the terms of these types of markets and the kind of actions that we've seen from the Fed, for example, under QE, I mean that's a drop in a bucket compared to some of those larger actions.
Very quickly before we let you go, is there still foreign haven demand, foreign haven bid, I should say, for U.S. Treasuries, or has that demand kind of migrated to things like gold?
Yeah, but if you consider the relative sizes of those two markets, it's something that you may not even notice that shift if there's a rotation into gold. You know, again, kind of what I was just saying with those big numbers, you know, the size of the Treasury universe is so big that the loss of that kind of capital as it moves into gold doesn't really do anything to Treasury yields, but on the gold side, it could be a much bigger driver. So it's just not something that we've really seen as a major driver of yields this year, even though there was a lot of fear of that after, you know, after Liberation Day.
Yeah, that was certainly a big theme post the announcement of reciprocal tariffs. Blake, really appreciate getting you on. Blake Gwinn of RBC, and our thanks as well to Lindsay Rosner of Goldman Sachs Asset Management. Coming up next on Bloomberg Real Yield, we've got the auction block, where global bond sales had their busiest start to a year ever, with more than $340 billion in sales. We're going to talk credit next on Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where global bond sales had their busiest start to a year ever. Now, when it comes to U.S. high grade, it was the busiest week ever for a non-COVID year. More than $90 billion was sold. Yankee banks contributed more than 40% of the volume. Monday and Tuesday were the busiest back-to-back sessions on record. In Europe, Wednesday's sales marked the largest amount ever raised in a single day, with more than $71 billion sold. Sales in the region took off after being delayed by a public holiday in several European countries. And all of this contributed to that record start to the year for global sales. There was more than $344 billion in total across currencies. Issuers that shelved borrowing plans in December, they piled into the market ahead of an earnings blackout that begins next week. Now, sticking with credit, Apollo President Jim Zelter is expecting to see strain in the investment-grade market.
Over the next 5 to 6 years, it's been bantered around that the hyperscalers in aggregate are going to need $5 to $7 trillion. About a third of it will be filled from their free cash flow, not OpenAI, but the other 6. The high-yield market, the investment-grade market, the structured finance and ABS market, they will all fill that. When you identify the gaps, it's another $1 trillion. It's a big number. It's definitely going to strain and have an impact on the IG issuance markets, where these companies were negligible participants. Now they're going to be 10 to 15% participants.
Let's dig into all of this with our credit roundtable. Meghan Robson is head of U.S. credit strategy at BNP Paribas, and Zachary Griffiths, head of U.S. IG and macro strategy at CreditSights. So, Meghan, let me get your take first on what Jim Zelter said. He sees a strain created in the IG market. What do you think?
So we have a little bit of a different take. We do expect, as he spoke about, a severe rise in supply from the hyperscalers, and we build in about $250 billion for 2026. But I think where our take is a little different is outside of some of these kind of AI build-out utilities, the tech sector, a lot of other sectors are seeing much more restrained borrowing. And I think that you're seeing the K-shaped economy, and that's also impacting some corporate behavior. So if you look at a sector like financials, you saw a lot of issuance from the Yankee banks this week, but we actually expect net issuance from Fins to move a little bit lower this year. So in balance, we think the supply backdrop for 2026 will still be manageable for spreads.
Okay, so the shift is moving around, definitely. Zach, the first full week of 2026, I almost said 2006, but that would be wrong. We saw issuers return to credit markets in a big way, yet spreads tightened because refinancing made up so much of the action. When the mix eventually changes to new money, what do you anticipate the spread widening to look like?
Yeah, we are looking for spread widening this year, Scarlett. Our call is for the US IG market to move to 120 basis points. And so I think Meghan makes a good point. Obviously, we're going to see a lot from tech and AI, maybe not as much on the financial side. We're not looking for that to be as big of a downdraft, but we expect more M&A in the market. You're seeing that across a variety of sectors already. So we are expecting that to be a bigger push in terms of net new money. And we think that the supply and demand backdrop shifts from such robust technicals that we've experienced over the past couple years, moving a little bit more in balance. And on the other side of that, we are expecting fundamentals to weaken as we have a slower economic growth outlook in 2026. So definitely looking for that wider spread environment, which could contain issuance in the second half of the year, but definitely a very strong start and a strong market to issue into.
Okay, so we were talking about the AI complex, and certainly they are moving forward with their plans because they have committed to it. Meghan, they're going to be flooding the IG market. You actually prefer investment-grade utility issuers over hyperscalers. Why is that?
It's a great question. So I think both utilities and the hyperscalers will be picking up issuance, so increasing leverage. But the utility sector, we're seeing increasingly tap the hybrid market. Corporate hybrids, you get a 50% equity credit. So from the perspective of a credit investor, the credit is much stronger in terms of that releveraging trend. Utilities is also, of course, a non-cyclical sector, less exposed to the equity market. So in playing the AI theme, we think utilities is the spot we'd rather be relative to the hyperscalers.
Yet the hyperscalers are going to have a lot of debt out there, Zach, and I wonder what kind of reception they will get when they issue that debt. How will it price, and how do investors make peace with buying really long duration, 40-year debt from a company that, could be out of business in 5 years?
That's one of our big concerns in terms of the perhaps asset liability mismatch in terms of what these tech companies are buying and investing in with this super long dated issuance. And so that's one of the concerns we have. We haven't underperformed on the IG tech space as we look ahead. We've certainly seen spreads widen relative to historic norms, but we think we're under a clear paradigm shift in terms of how much influence that will have on the market. And we consider if U.S. issuers are going to be going to other currencies to try and fund that, and how much appetite there may be in places like the Euro market. Some of these issuers haven't tapped that market in a long time. But if you look at the composition of the Euro IG market from a country risk perspective, it's already very heavily weighted toward U.S. So there could be some pushback there. We think that ultimately contributes to wider spreads in the space as well.
I do have a question on the issuance and it being such a fast start to the year. If people are convinced that the Federal Reserve is going to cut rates maybe 2 times this year, or if you're Stephen Myron, even more aggressively, why wouldn't you just wait to issue the debt? Bankers are telling companies to issue the debt right now, and CFOs are agreeing.
I think there's a lot of uncertainty in terms of what we'll actually get in Fed cuts. And when you think about the spread environment right now, it's very attractive. I think capital markets have been very robust. And so when you think about from a CFO's perspective, I think you fund when you can, not when you need to. And then that's the environment that we're in right now.
All right. Well, Meghan, you had mentioned the K-shaped economy in your notes and in your comments. Another risk out there that really became more apparent this week is Sachs and a possible bankruptcy filing. Sachs bonds are slumping, and whatever specific operational challenges that company faces, this is a company that caters to high-income consumers who have been spending reliably during this economic cycle. So do its struggles say anything about the state of the U.S. consumer? Do you worry that there could be spillover into other sectors, other companies?
On the consumer, we actually think that you still see the high-end consumer broadly as still very resilient. So many consumers have locked in their mortgage rates. The labor market, we got some news today. The unemployment rate actually moved lower, which is a positive signal. The place in the consumer that we're most concerned about is really that area that's exposed to lower income consumers. So I think leisure outside of the home, think some of the fast casual restaurants. Those are areas where we still have our eye on, where you could see if inflation remains sticky, demand still struggle to those segments of the market.
And as for issuance tied to M&A, Zach, there's a $7 billion loan funding Blackstone and TPG's acquisition of WholeLogic that went to market this week. And what's notable is the debt to equity ratio of 7 times. So the demand is there. It's certainly oversubscribed. But I wonder if this is a sign that borrowers are pushing the limit on how much risk lenders are willing to accept.
I think we're seeing signs of that also in the private credit market. For example, we've done some analysis on that, just looking at where spreads are and leverage, and you're seeing spreads tighten in as there has been this robust technical, while at the same time in certain parts of the market, you're seeing leverage rise. So kind of that disconnect between what you would think you'd see in terms of spreads relative to fundamentals. So there is some concern in terms of underwriting terms and perhaps a weakening there in this kind of rush to put money to work, and whether that's kind of deteriorating underwriting standards. That's another concern we have when thinking about the overall risk and return in the market, especially as we've seen yields even in places like private credit move into the single digits. So that risk return is becoming less attractive from our perspective.
Meghan, what do you think? I mean, we've seen Blue Owl Capital allow investors in one of its BDCs to withdraw up to 17% of net assets.
So for private credit to really see more problems, we think that you either need a recession or a bigger obsolescence threat to the tech sector, where you have a lot of exposure to software. Neither of those is in our base case. We think that you could continue to see some idiosyncratic issues in single names. In the leveraged finance space, though, we do have a preference for high yield. I think you're more insulated there to some of the private credit issues because you have a greater number of public filers. So you have greater transparency in terms of fundamentals, and it's a little bit easier to track what's going on.
All right, good stuff. Thank you so much to both of you for joining us today. Zach Griffiths of CreditSights and Meghan Robson of BNP Paribas. And if you want more talk on credit, please check out the Bloomberg Credit Edge weekly podcast on the terminal and wherever you get your podcasts. It's good stuff. It comes out every Thursday at 4 p.m. Still ahead, the final spread the week ahead. The next read on U.S. inflation is on deck. We'll give you all the lowdown. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the final spread, the week ahead. Coming up on Monday, JP Morgan's annual healthcare conference kicks off, and we'll get a bunch of Fed speak. On Tuesday, December CPI and the U.S. earnings season gets going with JP Morgan Chase and Delta reporting. Wednesday, more earnings with Wells Fargo, Bank of America, and Citi, U.S. PPI data, and the Fed releasing its beige book. On Thursday, the earnings continue with Goldman Sachs, Morgan Stanley, and BlackRock. There's a bit more Fed speak before the central bank is scheduled to enter its blackout period over the weekend, plus earnings from PNC and State Street. And for my final thought, we are looking ahead to next week's CPI print. Mike McKee, our Bloomberg International Economics and Policy correspondent, says this might not be a completely clean read, but it's the latest read we get of U.S. CPI, and right now we're looking for a headline number of 0.3% increase month over month. And if you strip out food and energy, also 0.3%. From New York, this is Bloomberg, and it does it for me and Real Yield this week. See you next week.